is up, everybody, and welcome back to the Fresh Finance Podcast. My name is Thomas Elms, and I'm with my co-host, Kyle Ryan, as always. Today's conversation is going to be all around employer stock and employer stock options. So we're going to be talking in, I would say, a little bit of detail. We're going to kind of cover the basics today. Kyle, I'm sure you'd agree with that. We're not going to go into too many of the specifics because you can really go down rabbit holes here. But what we really wanted to do is just create an episode that has kind of some basic 101 knowledge on receiving company stock in a 401k and utilizing the opportunity for net unrealized appreciation, so NUA, or also receiving other sorts of employee compensation outside of just a salary. So that's incentive stock options, non-qualified stock options, and also employer stock purchase plans, which are ESPPs. Those are becoming very common. And just kind of the mechanics around it. Kyle, I'd love to just kind of get your overall thoughts on the conversation before we start.
Yeah, I'm excited for this one because, at the end of the day, you run into this more often than you'd think, especially an advisor, finding a client who has stock within their own company. And there's a lot of unique opportunities to save yourself money on taxes and help contribute to the overall growth of your financial plan. So I think we're going to cover a lot of good topics here.
Perfect. So kind of diving right in on the NUA conversation. So NUA stands for net unrealized appreciation, and we'll walk through what that actually means here in a bit. But one of the things that we want to hit on is just at least first is a quick retouch on how retirement accounts are taxed. So if you have a pre-tax or traditional account, normally this is in the form of a 401k, the money that you can contribute is tax deductible at that point in time. It grows tax deferred. And then when you take the money out, that's when you're taxed on any sort of distributions or withdrawals. Now, with a Roth retirement account type, a Roth 401k, you're contributing the money after you paid taxes. The account will grow tax deferred and any withdrawals are tax free. So we just wanted to make that difference because we're most likely going to be talking today about the traditional side of things when using NUA. And Kyle, I'd love to just kind of have you talk through this, but let's say that there's somebody who works for a company that's giving out employer stock through their retirement plan. And then let's say that they either retire or decide to change jobs and they have this bulk of company stock inside of their retirement plan. Can you kind of just walk us through both the options that you have available to do with the company stock, but also how NUA can possibly be a good opportunity?
Yeah, of course. Essentially, with a 401k, you'll have all the different investment options that your 401k provider will allow you to invest in. And then sometimes it depends on the company, but sometimes your company will actually allow you to buy the company stock within your 401k. It's a really unique opportunity. And if you believe in your stock, it's, a really good way to participate in the upside. And taking it a step further, it's really good for the company because if you are an owner of the company, you're going to want to see it do better. Therefore, hence the reason why these companies offer their employees stock. If you're an owner of the company, you're going to want it to do better. So let's really talk about how it works, right? So let's say you do have a 401k and you have the opportunity to buy the company stock. You've been there, say 30 years. Over the course of your career, you've put in $50,000 into this stock, your company stock, separate of your 401k, right? So $50,000, let's say that's what you put in all of those years. Let's say it's worth $500,000 now, right? You were there for 30 years. It's a good chance it could have grown like that. So you have $50,000 of what's referred to as cost basis, the amount of money that you put in. It's worth $500,000. So you have $450,000 of gains. As Thomas alluded to in a traditional 401k, if you put money in, you get a tax deduction going in. You take money out, you get taxed on it going out, just as if you made it at work, your ordinary income tax rates. Now, there is a preferred set of tax rates, and it's called the capital gains tax rate. I've never run into a circumstance, doesn't mean it's not there, but I've never run into a circumstance personally in which your capital gains tax rate would be close to your ordinary income tax rate. It is almost always lower, which means you want capital gains tax treatments because you pay less money to taxes, which means you keep more in your pocket. Wonderful thing, right? So the question is, do you want to pay the government more taxes or less taxes?
Yep.
It's pretty easy, right? So if you do not take advantage of an NUA opportunity, net unrealized appreciation, your $500,000 worth of stock, when you take it out, sell it, take it out, distribute it to yourself, you could pay ordinary income taxes. but if you do it correctly, you could avoid a lot of taxes, right? So what happens here is you have $500,000 of stock in your 401k. You can carve that $500,000 of stock out, move it to a brokerage account at a, an institution of your choice. It doesn't matter. But now you have $50,000 of cost basis and a $500,000 total account value in a separate account. What's going to happen here? You're going to get taxed on your $50,000 of cost basis as if you made it at work, right? Because let's back up. You put 50 grand in, you got a tax deduction. You're taking it out, just your cost basis. You're going to get taxed on that $50,000. But that allows the rest of your money, the other $450,000, to get taxed at a much more favorable rate. Typically, it's either 0, 15, or 20, versus the much higher tax rates you would assume in those brackets if you're there. So NUA is a really, really unique opportunity for folks who have worked at a company for a long time, have seen the stock price in that company raise significantly, to really get better tax treatment on the gains in their stock.
Yeah, 100%. And I think one of the caveats that you do want to make sure of is you do want to hold that position for at least a year to continue to receive that NUA treatment. You don't want to go ahead and roll it out of a 401k and, essentially be owed the 50,000 in ordinary income taxes. At least that 50,000 is going to be taxed at ordinary income rates, and then just sell the whole position. You want to go ahead and hold that for at least a year. Now, if you need to sell it, that's obviously a consideration you need to make. But the goal is to obviously hold the position for at least a year. And I think that's just a small little piece that a lot of people don't necessarily recognize. And with how prevalent company stock purchasability, I would say, inside of a 401k plan is in today's world, especially depending on the company's growth, that can be a huge tax saving opportunity that you can look at, where if you aren't working with an advisor, especially somebody who is either geared towards a stock option based clientele or a CFP, you're probably going to miss out on that opportunity. And, I know both of us have had the ability to work with clients who can utilize that NUA ability. And, it's definitely a great option to even kind of get a little bit of liquidity outside of a 401k, especially if you're somebody who's younger. Let's say that you started with a tech company at 25 and you worked there for 15 years, let's say, and you're 40 now, you're leaving that job, you're going to roll your old 401k either into a new plan or into an IRA. And, you've got maybe a good sized balance of your 401k in stock. You've got the ability to create a little bit of liquidity outside of that first year from separation. When you utilize the NUA that you might not have had elsewhere, unless you would have done that NUA treatment.
And the only thing to be really careful of is if you're under 59 and a half, that money that's your cost basis, that could be penalized if you take it out under 59 and a half, because again, it's the distribution from a retirement account, just like any other retirement account, IRA, 401k, anything really other than a Roth under certain circumstances. You will be penalized an extra 10% for taking it out before 59 and a half. So another caveat to be aware of. And look, it all sounds like a wonderful idea, but sometimes it's just not worth it, right? If you don't have a lot of capital gains in there, right? Say it's your cost basis is 30,000 and the stock as a whole is only worth 40. You're going to take $30,000 of ordinary income tax this year to save on capital gains of 10,000. In some cases it can work, in other cases it might not. So that's, my favorite answer to that question would be, it depends on your certain circumstance, whether or not it works for you.
Yeah, absolutely. And kind of moving on here into the specific stock option sections, kind of incentive stock options, ISOs, non-qualified stock options, NSOs. Would love to just kind of get your take on process and kind of some terminology, because one thing that we'll throw out there is the grant date, the exercise price, and when you have the ability to then go ahead and sell the stock. Can you kind of walk us through that process?
Yeah, of course. So as we refer to them, ISOs and NSOs, incentivized stock options, non-qualified stock options, sometimes called NQSOs. How they work, again, just going back to the fundamentals here, is your company is rewarding these to you, granting them to you because they want you to be vested in the company, right? How ISOs work, incentive stock options, is your company will grant you shares at a given stock price, right? So you work for XYZ company, they say, okay, we're going to allow you to buy these shares at $100 a piece. That's the day they're granted. All right. So now all of a sudden, say you have one share of XYZ stock at $100 a piece. That's where you're at today. Now, in a year, you can exercise those stock options, right? Say the stock's worth $200 now, right? So it went from 100 to 200, whatever it is. You have to come up with the time at exercise to purchase what you were granted, meaning your one share at $100, you have to come up with $100 in order to get long-term capital gains on the rest of your gains, right? So you get granted shares of a company, you have to wait a year to pay for them and exercise them. And after that point, you have to wait another year if you want to sell them and get a long-term capital gain. ISOs are typically less common now, in my opinion, in my experience. They're typically reserved for like the C-suite because of the tax incentive there. And usually we're not talking one share getting granted, we're talking about thousands. So when you come up for the bill to pay for these shares, it's not $100, it's tens and tens of thousands more often than not. They're usually reserved for the C-suite, but the advantage is that you get long-term capital gain treatment once again of your company stock. Now, on the flip end of that is a non-qualified stock option. You are not qualified for some of the incentives of the incentivized stock option. So what happens here is if you do not have the money to come up with the money due at the time of exercise, right? Share price times the amount of options at that given strike price. If you don't have the money for that, it's no longer an incentive stock option. A lot of times they're not even granted as incentive stock options. You're just going to get granted non-qualified stock options, which there's nothing wrong with it. So let's say you get granted a stock at $100 and you want to exercise it at 200. You don't have to come up with any cash. You just get the difference between what the strike price was and what you sold it at. So if you got given at 100, you sold it at 200, you have ordinary income tax, not capital gains, not the good one, ordinary income tax on that $100 difference per share. So the main difference, plain and simple, is that the gains can either get taxed at a more favorable capital gains tax rate or a less favorable ordinary income tax rate, depending on if you qualify for the ISO or not qualify and receive the NSO.
Yeah. And I think the overarching, theme of this conversation is these things can be incredibly complex. And so if you're in a position where you're receiving these ISOs or these NSOs, you want to definitely have, a tax professional in your corner that has knowledge in how these works and can help you do preparation and planning on, when the correct time to utilize these things is. And you also want to have somebody that's in your corner that is a financial planner that can also help be a soundboard and walk you through cash flow and things of that nature. Because if you do need to come up with cash to purchase these things, you've got to have some sort of a savings goal towards that. That's got a timeline that matches up with your exercise date. So, having different plans for that is really important. And, kind of the last piece that we wanted to touch on, and something that I'm actually seeing a lot more prevalence in, is employee stock purchase plans, ESPPs. And it's essentially a company that is offering employees a discount to purchase their shares. And it's normally offered on a quarterly basis. And I think that when I say employee discount, it starts to resonate with people because let's say you work at Target, right? I'm just going to throw out a random company that I was at, over the weekend, spending more money than I probably should have. But let's say you work at Target. Most Target employees are going to get some sort of an employee discount when purchasing any sort of item in the store, right? So this is the same thing with an employer stock purchase plan. Is you have the ability to purchase that employer's stock at a discount. Normally it's anywhere from the 15 to 20% range. And it offers you to pay them through payroll on a quarterly basis. So you'll essentially throughout a quarter, a portion of your payroll income will go towards that. And then they will actually go and take that cash and then buy the stock on a quarterly basis based off of that, that discounted strike price throughout the given time frame. And it's a great way to purchase and acquire shares in the company at a really great price as well.
I have to be careful. I can't say I love certain things for compliance reasons, but like ESPPs can be very beneficial in the right circumstance. Employee stock purchase plans, same things with ESOPs, ESOPs. And just kind of you've really hit it on the head. Just to kind of add a couple more details there. So usually you'll get, I've seen a 15% discount. So say your company stock is offered at $100, you can buy it for 85. Now you're going to get taxed on that difference as if you made that money at work, but I'd rather pay taxes on it than not get the discount, for one, right? You're already ahead of the game. I think my favorite part of employee stock purchase plans is depending on what they refer to as the observation period. Thomas, you refer to it as quarterly. So I've seen quarterly, semi-annually, whatever it is, we use quarterly. So the stock will do what it does from January 1st to March 31st, first quarter of the year. And depending on your company, what's really cool is they'll offer you the lowest price in that period. Meaning if it jumped from 100 down to 50, back up to 150 at the end of the quarter, you're buying it for 50 and it's worth 150. And not only that, you're buying it at a discount off of 50. So, they limit the amount you can purchase each year. I think it's 25,000. I could be wrong on that. But they limit the amount you can purchase. Like Thomas said, you buy it through your payroll, but if you believe in your company's stock, again, it's all dependent on your individual circumstance, but these can be really, really beneficial. You're buying it really low. I mean, I remember seeing people's ESPP statements now, looking back at like the 2008, 2009 era when they were buying at just the most depressed values. And then 2 years later, they were already doing pretty dang well for themselves. So ESPPs and ESOPs can be really good opportunities for people.
Yeah, absolutely. The one last thing that we wanted to touch on just really quickly, and we're not going to go into any details on this as we're not CPAs, we're not registered tax preparers, is if you are running into a situation like this with your career and with the benefits package that you're offered at your job, whether it's incentive stock options, non-qualifieds, ESPPs, maybe not necessarily ESPPs, but you want to be careful of what's called an AMT. It's called the alternative minimum tax. And whenever you're starting to deal with the E word that I call it, anything exercising, when it comes to stocks, you're going to start approaching the AMT conversation. So you really want to make sure that you're working with a tax professional and a financial advisor that know what that process is. The situation varies immensely from person to person. That's why we're not going to go into too much detail there. But make sure that that's something that you take into consideration when it comes to exercising any sort of stock options. It's definitely something that you want to consider and, recognize the ramifications on your tax bill when something like that comes up.
Yeah, alternative minimum tax, that's no joke. Thankfully, it's less prevalent in the last few years, but yeah, you could definitely get whacked with it if you have stock options. One last thing I wanted to cover, Thomas.
Yeah.
RSUs, restricted
yes.
stock units. These are becoming more and more common in my experience. RSUs are really interesting because I've had clients who have RSUs and don't even know they have them because they are what's called a cashless exchange. Okay, so it's another sort of stock option plan that your company can offer you. Now, typically what will happen is very similar to the other ones. We're going to use a lot of the same language. They can grant you shares of the company, right? So they'll grant you, typically it's over a 3 to 5 year vesting schedule, which means you receive those shares. Say it's over a 5-year vesting schedule, you're going to receive 20% each year until you're fully vested, right? So what's happening here? You're getting gifted. I don't want to use the word gifted, but you're essentially getting gifted shares by your company. Now, what's going to happen is say you receive $10,000 worth of shares. That's taxable. Okay, so that's taxable. What they're going to do is, the reason it's called a cashless exchange is because you don't have to pay the taxes on those. What's going to happen is your company will automatically sell the amount of shares that they believe is necessary to sell to cover your tax bill, right? So just say it's a 20% tax rate. If you get 10 grand, they're going to have to sell $2,000 worth of your stock to cover the tax bill, meaning you have 8 grand in your RSU left over. I run into situations because it all happens in your pay stub. You don't receive, usually, you might receive a statement or something, but usually it happens really behind the scenes. It'll come up on your taxes, and unless you're taking a close eye to it, you might not notice it. So they can really go under the radar. I mean, we've had clients who have hundreds of thousands of dollars in RSUs, and they're like, what's that? And they're like, I don't know.
Yeah.
So they're pretty interesting. You have to wait until they're vested. They're granted to you as an employee. Typically, they'll grant you them year after year, and you'll get vested on them over time, whether or not you choose to sell them once they are vested, whether or not you choose to hang on to them. It's totally up to your choice. Depends on your individual circumstance again, but RSUs, restricted stock units, are becoming increasingly, I don't want to say more popular, but I'm seeing them more and more often.
Yeah. And I think that this whole employer stock option conversation is kind of becoming the new pension. And I think it's because it's a little bit more short-term productive, because when we think about pensions in the 90s, and that, well, in the 1900s, I'll say, that's a little bit more apt description, but pensions in the 1900s were a much more long-term play. And I think that people were much more geared towards finding a job and working for that company for their entire life. That is not not today's environment. I think that especially for millennials and Gen Zs, the average working timeline within one specific company is like 5 years now, which is incredibly short. And so I think that companies are starting to use these incentive opportunities within their employer stock. And this is both publicly and privately traded companies. And they're trying to use it to incentivize people to come, and continue to stay to work with them, but it also gives them more capital that they can utilize within, the acquisition of those stocks. And so I think that's kind of an interesting comparison between the pension to the stock ownership piece that I think is just worth noting.
I couldn't agree more. We like to refer to them as golden handcuffs from the
Yeah.
company.
Yeah. Golden handcuffs. That's a good one. I like that. But yeah, so, Kyle, I don't have anything else to share. I don't know if you did, but
Nope.
we really just wanted to come together and put together something that just kind of scrape the surface on the option side of employee benefit packages that people are starting to receive more frequently. If you guys have more questions on this about maybe your specific situation, please feel free and reach out to Kyle and I. We're happy to kind of walk through and see if there's anything we can do to help you guys maybe better understand your situation or start planning if that's something that you might be receiving in the future. Please feel free and reach out to us as well if you have anything that you would like us to talk about on the podcast. Always open to thoughts or questions or ideas about content. We do this for you guys. We want everybody to learn and to grow from the things that we talk about. And the best way to do that is to ask questions and have us talk about it. So thank you to everybody that's watching, listening, maybe doing a little bit of both, and we'll see you next time.